All right, everybody, let's jump into this. It's election year, and you know what that means. Market volatility. It's a hot topic, and we're going to look at it. We're going beyond the pundits. No opinions here, just the facts. And for that, we're turning to some hard data. This analysis comes from Lucas Downey over at mapsignals.com. It's from October 31st, 2024. We're going to break down some of the key insights so you can be prepared no matter who wins in November. We're going to look back at elections all the way to 1988, Democrat and Republican wins. We're going to uncover some historical patterns, some of which might surprise you. For example, did you know that small cap stocks have historically performed very well after elections, even when the broader market takes a little bit of a dip? Well, let's get into it with our expert.
You know, markets are all about expectations. And frankly, they hate surprises. And elections, of course, bring a ton of uncertainty. You've got new policies, potential regulatory changes, and of course, all the media frenzy that goes along with it. All of this makes the big investors nervous.
Right. Makes sense. It's like the whole market is just holding its breath.
Exactly. And we can actually see this happening right now. So Map Signals has this really neat metric. It's called the Big Money Index, or the BMI for short. And the BMI tracks the activity of institutional investors, the big players in the market. And guess what? It's falling, meaning these big investors, they're pulling back, they're getting cautious ahead of the election.
So they're battening down the hatches, expecting some rough seas.
Yeah, you could say that. Now, this analysis from Downey, it isn't just about the current climate. He goes deep into the historical data, and this is where things get really interesting.
Yeah, let's get into the history. So give us the details. What happens in those nail-biting weeks, right after an election?
Okay, so on average, both the S&P 500 and the NASDAQ 100, they tend to dip in the first 2 weeks after the election. It's not a huge drop, but it is noticeable. The S&P 500 drops about 0.7% on average, and the NASDAQ 100 drops about 1.2%.
So just a little bit of a knee-jerk reaction to the results. Everyone's trying to figure out what the new landscape's going to look like. Makes sense. But what happens after that when the dust settles?
Well, things actually start to stabilize pretty quickly. After 2 months, the S&P 500 is generally back in positive territory, showing an average gain of 2.4%. The NASDAQ, on the other hand, tends to be a little slower to recover, with an average gain of just 1.4% after 2 months.
Okay, so large caps, they kind of find their footing after a little while. But you mentioned earlier that small caps actually perform well during this time, so tell me more about that.
Okay, this is where it gets really fascinating. While those large cap indices are dipping or just starting to recover, the Russell 2000, which tracks small cap stocks, actually shows an average gain of 6.6% just 2 months after the election.
Hold on, 6.6%. That's a big difference. So what's going on there? Why are small caps surging while the big companies are lagging behind?
Yeah, it's a great question. It really gets at the heart of how different segments of the market react to these kinds of events. Now, one theory is that small caps tend to be more domestically focused. So any changes in policy or regulation that might come with the new administration, they could benefit certain sectors within the small cap space more directly.
So they're more nimble, more able to adapt to any changes in the landscape.
Right, exactly. And let's not forget that elections often bring about stimulus packages, infrastructure spending, things like that. And those can also have a more immediate impact on smaller companies.
So for investors who are maybe a little more comfortable with risk, small caps might present a really interesting opportunity in those months following an election.
Potentially, yes. But of course, as always, do your own research. Look into specific companies before making any decisions.
Absolutely. We're not giving financial advice here. We're just exploring these historical trends and seeing how the market tends to react to elections. But this is all just the short term, right? Let's zoom out a little bit and look at what happens over the longer term. Say 6 months out, 12 months out.
All right, so if we look 6 months out, all of the major indices tend to show pretty healthy gains, regardless of who won the election. The NASDAQ 100 is up an average of 5.6%. The S&P 500 is up 7.1%. And the Russell 2000, once again, is leading the pack with a 10.6% gain.
So regardless of the initial jitters, the market tends to find its footing and move forward.
Exactly. And if we look a full year out, the gains are even more impressive. The S&P 500 is up an average average of 15.3%. The NASDAQ is up 17.6%. And the Russell 2000 comes out on top again with a 20.4% gain.
Wow, 20.4%. So betting against the market after an election seems like maybe not a great idea, but these are just averages. There's always going to be variation depending on the specific circumstances of each election.
Absolutely. And we will delve into some of those nuances in a bit. But before we do that, I'm curious, what stands out to you so far? Are you surprised by how resilient the market seems to be in the face of such a potentially disruptive event like a presidential election?
Yeah, honestly, I am a little surprised. I think it's easy to get caught up in all the media hype and assume that the election is going to make or break the market. But history shows that that's just not the case.
Yeah, it's a great point. The market is, a complex system driven by countless factors. And elections, while significant, are just one piece of that puzzle.
Right. And it seems like over time, the market tends to adapt and find a new equilibrium, regardless of who is sitting in the Oval Office.
Exactly. And that is a really important takeaway for investors to keep in mind. Don't let that short-term noise drown out the long-term signal.
So before we move on, I want to make sure that our listeners understand something very important. We are looking at historical trends here. And while they can be incredibly insightful, this is not about predicting the future. Past performance is never a guarantee of future results. And investing always involves risk.
Couldn't have said it better myself. This information is meant to inform, not predict. It's about understanding the historical context so that you can approach your investment decisions with more knowledge and clarity. Now, let's dig into how the market has performed based on which party wins the election, because that is where some very intriguing patterns emerge.
All right, let's break it down by party. Does it really make that much of a difference in the long run, whether a Democrat or a Republican wins?
Well, there are some fascinating differences in how certain sectors and indices tend to perform under different administrations. For example, when a Democrat wins.
Oh, well, hold that thought. We'll uncover those juicy details after a quick break. Stay tuned.
When a Democrat wins, we tend to see an initial dip across all the major indices in those first few weeks. It's almost like a collective deep breath before things get going.
Okay. So a little bit of a delayed reaction then compared to when a Republican wins. Interesting. But what happens after that dip?
Things start to pick up steam, particularly for tech-heavy indices like the NASDAQ. After just 1 month, the NASDAQ is up on average 1.8%, while the Russell 2000 gains about 1.6%.
So a bit of a shift in momentum there, with tech and small caps taking the lead.
Precisely. And if you look at the 12-month performance, it's actually pretty remarkable. The NASDAQ sees an average gain of 29.3%, and the Russell 2000 almost mirrors that with a 29% increase.
Wow, those are some serious gains. So it seems like historically, at least a Democrat win has been pretty good news for the market, especially for tech and small caps. But what about when a Republican takes the Oval Office? What trends do we see then?
Well, now here's where we see some interesting divergence. With a Republican win, the NASDAQ actually tends to struggle a bit. It's down an average of 2.3% after 1 month and still down 3.1% after 6 months.
Huh. So it seems like tech in particular might be a bit more sensitive to a Republican victory. But what about the other indices?
Well, the S&P 500 and the Russell 2000 actually see gains under a Republican administration, though they tend to be a bit more modest compared to the performance we see after a Democrat win. The Russell 2000 is up an average of 4% after 1 month, and then up 9.6% after 12 months.
Okay. So while the overall market tends to do well in the long run, regardless of who wins, there are definitely some sector-specific nuances to consider depending on which party takes the White House. It seems like small caps in particular have historically been pretty resilient, showing strong performance no matter who's in charge.
That's a key takeaway. While there's always variation, small caps have historically performed well regardless of the winning party. Now remember, we're just looking at historical averages here. We're not saying this is a foolproof strategy or a guaranteed outcome.
Of course not. Past performance is never a guarantee of future results. Investing always involves risk, and it's important to consider all the factors at play before making any decisions.
Exactly. This deep dive is about equipping you with knowledge, helping you understand the historical trends and patterns so you can approach the market with more confidence and clarity. Speaking of knowledge, Downey actually recommends checking out mapsignals.com for more insights and resources. They have some great tools and analyses that can help you make more informed decisions.
Great tip. So if you're interested in learning more about how to navigate the market, especially during an election year, Map Signals is definitely worth checking out.
Absolutely. They really do provide a wealth of information and insights helping investors make sense of this often complex world of finance. So with all this information in mind, what's your biggest takeaway from all this? What stands out to you the most?
Honestly, what strikes me the most is that while election years can definitely bring some market volatility, history suggests that the market is ultimately pretty resilient. It seemed to find a way to adapt and move forward regardless of who wins.
I couldn't agree more. It's almost like a reminder that while politics can be incredibly divisive, the market at its core is driven by forces that transcend those partisan divides.
That's a really powerful point. It's so easy to get caught up in all the rhetoric and think that the election is going to make or break the economy, but history shows that's simply not the case.
Right. The economy, like, the market is a complex system driven by countless factors. And elections, while significant, are just one piece of that puzzle.
It's like we're looking at this giant tapestry, and elections are just one thread, albeit a very colorful one, woven into that larger fabric.
What a fantastic analogy. And that tapestry is constantly evolving, shifting, and finding a new balance regardless of which party is in power. This actually leads to a really intriguing thought that I want to leave with our listeners.
I'm all ears. Let's hear it.
Okay. Well, if history is any guide, the election outcome itself may matter less than the market's ability to just adapt and move forward. It's a concept worth pondering.
Okay, let's unpack that a little bit. What do you mean by that?
Think about it this way. The market is constantly processing information, reacting to events, and adjusting its course. Elections are a part of that process. But they don't fundamentally change the underlying dynamics that drive the market over the long term.
So even with all the uncertainty and noise surrounding an election, the market ultimately finds a way to course correct and continue its journey.
Exactly. It's a testament to the resilience and adaptability of the market, which in many ways reflects the resilience and adaptability of our economy and our society as a whole.
Wow. That's a profound thought. It really puts things in perspective. Instead of getting caught up in all the short-term drama of an election, maybe we should be focusing on the bigger picture. Those underlying forces that drive the market over time.
Exactly. Don't let the short-term noise drown out the long-term signal.
Okay, so we've covered a lot of ground here. From the initial jitters in the weeks following an election to the longer-term trends that we see over 6 and 12 months. But what does all this mean for our listeners? For those of you who are thinking about navigating the market in an election year, well, if you're considering making any investment decisions in the lead up to or immediately after the election, remember that history suggests that a little bit of a bumpy ride might be in store, especially in those first couple of weeks.
That's right. But don't let those short-term fluctuations scare you off. If you're in it for the long haul, things tend to smooth out. And as we've seen, there's potential for some really solid gains down the road.
Remember, this is not about picking winners or losers in the election. It's about understanding how different segments of the market have historically reacted to different political climates.
Precisely. It's about equipping you with knowledge and helping you make more informed decisions that align with your own financial goals and your risk tolerance. Now, with all of that being said, I think it's important to remember that investing is never a one-size-fits-all approach.
You got that right. There's no magic formula or crystal ball that can predict the future. But what we can do is learn from the past, understand the historical trends, and use that knowledge to navigate the present with a bit more confidence and clarity.
Absolutely. And if you're feeling a little bit overwhelmed or unsure of where to start, remember that there are resources available to help you. Financial advisors can provide personalized guidance, and websites like mapsignals.com offer valuable insights and tools for investors of all levels.
Great point. Don't be afraid to seek out help and advice. Knowledge is power, especially when it comes to investing.
Couldn't agree more.